banks. Stephanie, your thoughts there, because these bank stocks, if you just follow the message of the market, we're looking at some trouble here because those stocks are down. Are you expecting a banking crisis as well?
Well, I would say two things about that. One, we're going to obviously get a whole slew of financial earnings over the next week. I think they're the first group really to report.
Friday.
And I'd look at loan loss provisioning. I'm assuming that there's going to be a continued increase in loan loss provisioning. The other point I would make is that while they have raised deposit rates, they're still nowhere near in line with what you can get in a 6-month T-bill. But the problem has been largely ring-fenced by the Fed's program, where they let the Fed pledge these underwater securities to them at par. So I'm not as concerned about a banking crisis per se as a crisis in the shadow bank sector that doesn't have the luxury of pledging securities to the Federal Reserve at par to meet deposit outflows. I think that is maybe what the Fed's more concerned about, is because it's invisible. They can't see it, can't regulate it, and we know it's like the Wild West out there. They have been taking tremendous risks. I mean, look at the boom in private credit that didn't even exist, you know, several years ago. Now it's over $1 trillion, and it's growing so fast that the banks are trying to get into it. They're like, hey, we can't keep losing share to these non-bank players. We're going to get into that market too, which in my view is a sure sign that we're about to turn south in terms of credit quality big time. The other kind of tongue-in-cheek signal on that was Blackstone's addition to the S&P index a couple weeks ago. Blackstone, as you may know, is the largest alternative asset manager. So their inclusion in the S&P, in my view, marks a top in this alternative asset bubble that we've seen over the last several years, fueled in no part, as Tom mentioned, by this QE insanity that they maintained basically a decade of zero money policy when the economy was already well on the road to recovery. So long story short, I'm concerned about a crisis in the non-bank sector. But certainly these higher rates are going to cause some wheel to fall off somewhere.
Thomas, I think you share that concern about the shadow banking system.
Oh, the shadow banking system, and of course the banking system has a lot of loans out to the shadow banking system, so it comes back on them.
Yes.
Plus, I would remind people, though, that credit quality in the banks are going to be also dependent on how these interest rates go. So the fact that we have this term loan facility for government securities is fine, but there's that's only 25% of the total portfolios of these banks. So there's a lot of other things underneath there to be really careful about.
Well, look at this market near the highs of the morning, Adam Johnson. You just heard Stephanie saying she's going to sell into this. You're bullish. You've been bullish. You've been right. But do you want to
It's not been an easy right, however. It's been a sweaty, sleepless night kind of right.
But you've been right. And so I want to get your take on strategy here. Do you want to go looking for the companies that have pricing power?
Well, pricing power is always one of those things that I, as a stock picker, look for. But I think also just listening to the tenor of the conversation from, Jerry talking or worrying about a less than wonderful Christmas, to uncertainty around the Fed, to pressure on some of the banks, I think what it really does is underscore why people like me are going to big cap tech. Because if you're looking for growth, if you're looking for solid balance sheets, if you're looking for execution by management, if you're looking for innovation, if you're looking for artificial intelligence, on and on, the names, the groups that keep coming up, very simple, the names we all know: Apple, Amazon, Microsoft, NVIDIA. I hate to sound like a broken record, and you sometimes feel foolish just saying obvious names, and yet sometimes what's obvious is well, what's obvious and what you do. So, yes, I am actually long all those names. I'm putting more money into those names. I'm also looking at some of the sort of related, I call them the junior fangs, the next group down, Salesforce.com, Palo Alto Software, best in breed companies in their respective businesses. And I think that's an important theme right now.
Yeah, Jerry, what about you from an investment standpoint? You're now looking at areas of retail to invest. How do you do that in an environment when you're expecting bad times, when you're expecting weaker than expected macro story?
Well, I think you go with the companies that have shown they can succeed in this environment. And who is that? That's Walmart. They're doing fantastic. The spread between Walmart's performance and Target's has never been higher. That's at least partially a reflection of the overall environment. It's also how well Walmart's executing. But Costco continues to do well. TJ Maxx again stands for value. And you have to go with Amazon. I think they've got a long way to come back from some of the weakness that they showed.
Yeah.
And yet they, it's prime days now. They're doing great.
Right. Well, that's true. There's a lot of deals that you can get right now. Jump in, Joe Concha.
Just observing this conversation as a layman, 2008's been broached a couple of times, and that's an ominous year, right? And as a guy who, along with my wife, we look almost every night at the housing market because we're looking maybe to get a bigger home. But interest rates are just too high right now, and inflation is eating so much into our savings that we talk to other couples as well who are thinking along the same lines. And housing could be a real problem here because there appears to be a supply-demand imbalance at this point where there's a lot of supply and not a lot of demand because of the reasons I just talked about. Inflation 3 times higher since Donald Trump left office, and obviously interest rates being where they are doesn't make it really a great time to buy a home right now. You just got to wonder what's going to happen to that market.
And this is a typical sentiment right now. Thomas Honig with mortgage rates at 7.5%.
Oh, it's not just. It's everything in real estate, right? I mean, number one, housing, you can't afford it. Commercial real estate is in the tank. There's no credit available out there. I mean, it's not only that interest rates are high, but they're not willing to take on that risk at all. So that's dried up. And we're now even seeing it going into some of the warehousing, which was strong for a long time. But finally, given the outlook and the cost, that may be slowing. So I do think we really are in the early part of a very difficult economic period ahead, and we shouldn't get too comfortable with this as we look forward. I think it's just a matter of we got some difficult times ahead. It follows, you cannot put an economic system on an equilibrium around zero for this long a period and then move to a higher level without a lot of pain coming with it. And that, I don't think, is avoidable.
But are you surprised it has taken this long? I mean, I know in the past we've talked about it takes 12 months, 18 months to actually see an impact from higher rates. We've had 11 rate hikes, and we're still looking at the Atlanta Federal Reserve talk about outsized growth and no recession. So are you surprised that we've gotten to this point a year and a half plus after the Fed started this campaign to raise interest rates, and we're still not actually seeing the headlines of weakness?
Well, in some sense, yes, I am. But on the other side, as I mentioned earlier, if you think about that earlier period, they stopped raising interest rates in June of 2006. Bear Stearns, a major non-bank failure, came in the spring of 2008, and the Fannie and Freddie in the summer, and Lehman didn't happen to more than 2 years after they stopped raising interest rates. So we're absorbing this. It takes time, but you can see it filtering through the economy right now, and it's finally coming to the consumer, given that they're tapped out. The credit markets are really tight right now. So I'm not overly surprised that we're at it, just starting at it, really getting into it now, and I think it'll only get worse from here for a while.
I'll never forget the global financial crisis when I looked up and saw that Bear Stearns was going to be sold for $2 a share. Remember that? Eventually, J.P. Morgan went up to $10, but that in and of itself was such a wow moment, and it was reiterating what we were in at that point, $2 a share.